So I just wanted to review with everybody, right? You've got all these different option strategies, but it comes down to a little bit of a breakdown here. I'm going to go ahead and share my screen here, and just this is just a basis of kind of what we need to think about. So first of all, we have to remember when it comes to the underlying stock, right? It's going to do one of three things, isn't it? It's either going to go
Yeah,
up.
hold on, AJ. We're not getting access to your charts at the
Oh,
moment.
no, I want you to see a white screen. Are you
Oh,
seeing
okay,
my
okay,
white
okay.
screen?
Yeah. All
Okay.
right. Now
So,
that we're just gonna clarify that. Okay, go
yeah,
ahead.
I
Sorry.
want to just kind of have this white blackboard here, this whiteboard, I guess you call it. So stocks are either going to go up, they're either going to go down, or they maybe are going to go sideways. That's like the three directions that a stock could go, right? And if unless the stock has a bias, it's maybe a 33% chance it'll go up, 33% chance it'll go neutral, 33% chance it'll go down, right? And so when you're doing option trading strategies, the first thing you do is you kind of, depending on that directional bias, maybe it's more biased, like 50% it'll go up, whatever. There are strategies that people go to when they're trading the directional movement of stocks. And so if you think that it's going to go up, right, and it's not going to go sideways or down, the first strategy you should be thinking of might be a long call, right? Just buying a call option, because call options profit when the stock moves up. And so a long call kind of has this, um, at least on the in the money value, a profit and loss diagram that looks like this, right? It goes up at a certain strike price, then it just starts going up just like the stock, but it's at a cheaper price. So if you think it's going to go up, not sideways, not down, you might trade long calls, right? If, on the other hand, you think it's going to go down, well, then you've got this other type of stock option. It's called the put option, and it does the same thing as the call option, only in the opposite direction. So if the stock price goes down, then the put price goes up. In fact, I kind of drew that wrong. It's more likely that you would see something like this, where if the price of the stock goes down, the put option goes up in price, right? So that's your long put option. You would buy put options in order to profit if the stock was going down. But now a lot of people forget that if, you know, what you're confident in is that it won't go down, right? But you're not confident on whether it's going to stall going sideways or go up. So, what you're confident in is that instead of picking one of these directions, it will go, you're more confident that it's not going to go in a certain direction. Like it's not going to go down. It's either going to go up or sideways, right? And in that case, you'd reach for something called a bull vertical spread. That means that this thing is going to profit whether it goes up or sideways. So, in those two directions, right? It could go up or sideways, and this bull vertical spread is actually going to work for you. So, options traders reach for that bull vertical spread when they can't decide whether something is just going to stall or whether it's going to go up. All they're confident about is that it's not going to go down. Sip, do you see that subtle difference? Instead of being confident that it's going to go in one direction, you're confident that it's not going to go in the other direction, right?
Yeah.
Okay, so last thing here, well, not last thing. There's the whole thing where what if you're just confident it's not going to go up, but you're not sure if it'll go down or sideways? Well, then you would use the bear vertical spread. The bear vertical spread profits whether you go down or sideways. So they would reach for these different strategies depending on if you're confident that it's going to go in one direction or you're confident that it's not going to go in another direction. And then last but not least, I want to remind everybody that there's those neutral strategies. So, for instance, if you're confident it's going to go neutral rather than going up or down, it's going to go in this third direction, then a lot of times what we aim for is this strategy called a condor, right? The condor profits if it goes in that one sideways direction. Whereas if it's the other way around, where you're confident that it's not gonna go sideways, but you don't know whether it's gonna go or up or down, that's when you start to aim for that strangle, right? That strangle strategy profits whether it goes up or down, but it doesn't profit if it stays neutral. So these are kind of contradictions as well. And so a couple of things to think about is if you can be confident on what direction the symbol is going to go, up, sideways, or down, you're setting yourself up for higher rewards, but also higher risks if it goes in the opposite two directions. Whereas over here, where you're kind of like hedging your bets, you're saying, well, I will profit whether it goes up or neutral, or I'll profit in this case with the strangle, whether it will go down or up. In this case, I'm going to profit whether it goes sideways or down. You're going to set yourself up for less profits, but you're also gonna set yourself up for less risk. So everything in options, strategizing is a trade-off. So if you wanna be, have a sure thing in 2 of the directions, 2 of the 3 directions, well, then you're not gonna make as much profit because 'cause you're now increasing the probabilities you'll win, but you won't win by as much. You'll also not lose by as much because, the chance that you'll lose is way less. So, these are the directional strategies. When you have a directional bias on the underlying symbol, these are the directional strategies you tend to go to first, and then you tweak accordingly. And the last point I'm going to make, Sip, is these don't include, right? This is all in the money values. These don't include what happens to an option when time passes by or volatility changes, right? We can make money with options just letting time pass by or also playing into the fears that investors have, which raise the price of options. And when the investors are confident, it lowers. So there's a whole nother set of option strategies if you want to start playing on those influences well. But a lot of folks start with this directional bias. And so make sure, like if you're saying to me, you call me up and you said like you want to chit chat with option strategies with me, great. But if you're seeing something go up, make sure you're, resonating towards the first strategy that actually makes sense. I have people call me who seem very confident and they want to talk options, but they're throwing out strategies without the basics understandings, right? You can sound confident as much as you want, but make sure you have some of these basics around options trading in your, in your understanding before you go forward with more advanced strategies like we do at Trading Trainer.